Welcome to Financial Freedom FX. In today's video, we are going to talk about one of the most important and fundamental topics in the world of finance, the stock market. This is a term you have probably heard many times on the news, from friends or while scrolling social media. You may have heard that people make money, lose money, or even become millionaires through it. But what exactly is this system? How does it really work? Why do companies sell their shares to the public? And how can an ordinary person like you or me take part in it? These are the questions we will answer in this video, explained in the simplest possible way, so that by the end, you will have a complete and clear picture of what the stock market truly is. The stock market is basically a platform where ownership of companies is bought and sold. Companies divide their ownership into very small pieces called shares or stocks. When you buy one of these shares, you are buying a fraction of the company itself. It does not matter how small your ownership is. You are still a part owner. If the company grows, launches new products, or makes more profit, your shares can become more valuable. But if the company performs poorly, your shares may lose value. So owning a stock means sharing in both the rewards and the risks of that company. The mechanism of the stock market is very similar to any other marketplace. Think about a fruit market. If more people want to buy apples and there are fewer apples available, the price of apples will increase. If more people want to sell and there are fewer buyers, the price will decrease. The same principle applies to shares in the stock market. If more investors are buying a company's stock, the price goes up. If more people are selling, the price goes down. This constant movement in prices creates opportunities for investors and traders to make profits. For example, if you buy a stock at $10 and later sell it at $15, you have made a $5 profit per share. This buying and selling activity is what keeps the stock market alive and dynamic. Now, you might wonder why companies even sell their shares in the first place. The answer is simple: growth. Every company needs money to expand its operations. Whether it is to open new factories, invest in research, launch new products, or enter new markets, all of these activities require capital. Instead of taking loans from banks and paying interest, companies raise this money by offering a portion of their ownership to the public. This process is called an initial public offering, or IPO. For the company, it is a way to get funds without going into debt. For investors, it is a chance to buy into a company at the very beginning and benefit if the company grows in the future. In the stock market, there are different kinds of participants. Some are long-term investors who believe in the company's vision and hold shares for many years, even decades. Their aim is to grow their wealth steadily and benefit from dividends, which are payments made by companies from their profits. Then there are traders, who operate on a much shorter time frame. Traders may buy and sell shares within weeks, days, or even minutes. They are not concerned about the company's long-term growth. Instead, they focus on short-term price movements. For example, a trader might buy a stock in the morning and sell it in the afternoon if the price rises slightly. Both investors and traders are essential because they bring money and liquidity into the market, making it easier for everyone to buy and sell. There are two main ways people make money in the stock market. The first is capital gains, which happen when the price of a stock increases and you sell it at a higher value than what you paid. The second is dividends, which are like rewards that companies give to their shareholders when they earn profits. Some companies pay dividends regularly, while others reinvest their profits back into the business for further growth. In both cases, shareholders can benefit, either through direct income or through long-term value appreciation. But of course, the stock market is not all about profits. It also involves risks. Share prices do not always go up. They can also fall sharply if a company performs badly, if there is an economic slowdown, or if negative news hits the market. For example, if a company is caught in a financial scandal, its stock price can collapse overnight, and investors can lose a large part of their money. This is why research, knowledge, and risk management are extremely important. Successful investors Do not blindly follow rumors or buy stocks just because others are buying. Instead, they study the company's fundamentals, its financial health, and the overall market conditions before making decisions. Even though risks exist, people still choose to invest in the stock market because historically it has given better returns compared to savings accounts, fixed deposits, or even real estate in some cases. For example, while a bank may offer only 5 to 7% annual interest on your savings, the stock market, when invested in strong companies, has the potential to give returns of 10, 15, or even 20% annually over the long term. This is why the stock market is seen as one of the most powerful tools for wealth creation and financial freedom. Let me give you a real-life example to show you the power of the stock market. If you had invested just $1,000 in Apple shares in the year 2000, today that investment would be worth more than $50,000. Imagine that. Your money would have grown 50 times over in just 2 decades. Of course, not every company grows as dramatically as Apple, but with patience and good research, investors can find opportunities that multiply their wealth over time. Another important point is that the stock market is not only for the rich. Many people think they need thousands of dollars to start investing, but that is not true. Most stock markets allow you to start with a small amount of money. Even a beginner can open an account with a broker and start buying fractional shares. The key is not how much money you start with, but how consistently and wisely you invest. So, in simple words, the stock market is a platform where companies raise money by selling shares, and investors buy those shares to become part owners. It is a place full of opportunities, but also full of risks. Success in the stock market does not come overnight. It requires knowledge, patience, and discipline. If you take it seriously, it can change your financial future, help you build wealth, and even give you financial independence. Thank you for watching this video on Financial Freedom FX. If you found this explanation helpful, make sure to like, share, and subscribe to the channel. In the next video, I will guide you step by step on how beginners can open an account and start investing in the stock market, while also showing you the common mistakes to avoid. Stay tuned, and I will see you in the next one!